Welcome back. This is part 17, exercise case number 4, a small one. So let's directly look to the case. Here it is. Here our protagonist is now pretty poor. She is an Indian-born English citizen, lives in London, and she has a very, very unfortunate fate because in our case, her only goal is to die. And now when she dies, she has a daughter. And the daughter is a bit more lucky in life because she is pretty rich. Pretty rich, born poor, is living with her husband in London, GB, too. Pretty rich inherits all the property of pretty poor. Um, that's a bank account in a German bank. It's a house in Düsseldorf in Germany, which is let to tenants. The market value is 450,000. The house has been financed partly by a credit that was originally 400,000, and a huge amount has already been paid back, but 250,000 of the credit have not yet been paid back to the bank. The remaining property of pretty poor amounts to 575,000 euro all over the world. It is located outside of Germany. Now, if you make first subtotal, you arrive at the conclusion that pretty poor has approximately 1 million euro of property. But this is London. They are all investment bankers, and if you have only 1 million, you are pretty poor from the perspective of your neighbors. That justifies the name. Apart from that, not everybody lives according to his or her name. That is also something which you should get used to. These senseless things said successfully, we can turn to thinking about the case solution. Well, the first thing is naturally, is there a taxable event? Well, here we have what we always have at the beginning, the question if there is a taxable event, and we suppose again, because she dies, that's an acquisition on ground of death. And as you and I should already remember, that was the acquisition on ground of death was defined in paragraph 3, and indeed an inheritance is the acquisition on grounds of death. So the introduction is already safe. So the first thing which we have to bother about is that the question is, do we have a taxable event? And we have already answered that. Yes, paragraph 1, number 1, in combination with paragraph 3, number 1 of the inheritance tax. It's an acquisition on grounds of death. Now, the tax liability, that was always the second point, unlimited or limited tax liability. That was a case where we need to check paragraph 2 of the Inheritance Tax Act, and as we say that, we should also do it. So unlimited tax liability applies to cases where we have natural persons who have residence in the inland. We don't have one. Pretty poor and pretty rich both live in London. German citizens who have left the country less than 5 years ago, pretty poor and pretty rich both are not named as German citizens, and it seems to be highly plausible from the circumstances of the case that neither she nor she is a German citizen. So yeah, well, German citizens without any 5 years limit, if they are a diplomat or a member of a household of a diplomat, this is clearly a plain no in our case. Then the two are not corporations, and so nothing is left over. They are not a family foundation because they are natural persons, human beings, so all that is gone. the only thing which remains for us here is limited tax liability to one number 3, because there is no inhabitant of the inland. No? Okay. So 2.1 number 3, limited tax liability, because none of the two persons involved is an inhabitant of the inland. So only inland property is subjected to inheritance tax. And now we must find out what inland property is. And let's have a look again. Inland property is here defined as inland property as defined in paragraph 121 of the valuation law. So we will have to look to the valuation law in order to find out what is taxable here. So let's go to the valuation law. Let's look for 121 valuation law. Here it is. Inland property comprises agricultural and forestry property located in the inland, real estate in the inland, business property located in the inland, shares in a corporation if you have a major participation in an inland corporation, patent rights protected in a register in the inland, assets which are not covered by numbers 1, 2, and 5 but are used by a business in the inland, especially those which are let for rent to a business, mortgages if they refer to inland real estate, claims from the participation in a trade as a silent partner, and rights referring to an asset in numbers 1 to 8. So that's relatively narrow. That's not so much. So we have to look through our case if something applies to the property which changes owner here. Well, let's begin with position number 1, the bank account in Germany. That is not named in paragraph 121 Bewertungsgesetz, so not covered by limited tax liability. You must keep that in mind, or you must remember that the reason was that money in a bank account can so easily moved abroad or being brought to the inland that it would be entirely subject to manipulations, easy manipulations, if such a position, such an amount of money could be subjected to inland inheritance tax or not. That makes no sense. You would just ruin inland banks, because people would then just refuse to hold inland bank accounts if that would make a difference concerning inheritance tax. So no taxability here. The house in Düsseldorf, that was inland property under paragraph 121 number 2. It's real estate in the inland. We saw that just now, just 1 or 2 seconds ago. Now the tax base, we forgot to name that. Paragraph 10.1, sentence 1 and 2, the enrichment minus tax-free amounts. That was a general description. Well, that was just because we forgot that before. And now to value the house. What have we also forgotten? Tax arisal. So, not good. No, so, arisal of the tax. That has still to be done. 9.1, number 1, day of death of poor. Well, so for that was the tax base, and there we could bring that sentence about the enrichment, so would better be placed there. And then minus free allowances, minus tax-free allowance. And there we would then probably have to add up that the bank account is not taxable, and let's begin a new part of that page with the house in Düsseldorf. So that number 2 and the house in Düsseldorf is to be valued on the day of death of pretty poor. That's paragraph 11. To be valued according to paragraph 12.3 of the Absorptive, that's with the market value. That's here 500,000. But according to paragraph 13d Absorptive gazettes, only 90% of the market value count. That was 13d1 of the Inheritance Tax Act, but we are not sure, and even if we are sure, we should look it up just to be on the safe side. You probably still remember that rule. That was a special, rather arbitrary rule, that houses which are let to tenants are only taken into account with 90% of their market value. And that was subject to the condition that 13d3, the house is let to tenants for housing purposes, that the house is situated in the inland or the EU or the EEA, and that it is not a part of a business property. That seems all to be fulfilled here. So that means we can evaluate that house at 90%. Because the house is let to tenants, is in the inland, and is not part of a business property. See paragraph 13d3 of the Inheritance Tax Act. The house also doesn't have to be passed on to somebody else, and so on and so on. Now we have, ladies and gentlemen, liability. Treatment of the credit liability. It's deductible under paragraph 10.5, number 2. Liabilities which you get from the disease are deductible. Now the question is it deductible as a liability in the framework of the limited tax liability 2? And for that we will have to look again into 121 or 10 of the Inheritance Tax Act. So let us have a look here. What do we find here? The Bewertungsgesetz says real estate in the inland. That's not the case. We deal with the liability. Mortgages and similar rights, if they are secured directly or indirectly by an inland real estate, that refers to positive assets. What they aim at, what they want to explain here is the claim on the mortgage. So we do not have anything which regulates the deductibility of the liability here. So let's have a look to the Absorptive gazettes, and let's look to paragraph 10, because there was something 10.5, obligations resulting from or debts of the deceased persons, 10.5 number 1, as far as they are not connected with the business, because with the business assets and liabilities would directly be netted off against each other, and there would be a complex valuation process where both is taken into account. 10.6. Not deductible are debts and financial burdens as far as they are related to assets which are not subject to taxation according to this tax act. The house is related to taxation. So that would be deductible. The debt is economically related to that. Now, sentence 3, debts and other financial burdens are not deductible as far as the assets to which they are economically related are tax-free. Yeah, that means if only 90% of the tax value of a house is taxable, then only 90% of the liability can be deductible. Plain and simple. 10. 5 number 1 and 10.6 sentence 3. These were the things which we have to store in our memories, and then we have to write them down naturally as soon as we can, simply now. So first we have to correct a small mistake. That was 10.5 number 1. You see from my own experience here that if you just trust only your memory, that leads you astray. So you have really always to look things up. So it's deductible under 10 because it is a debt which has been taken over from the disease. It is, however, only deductible insofar as it relates to inland property. That can be concluded from paragraph 10.6 sentence 1, and as only 90% of the house is taxable, only 90% of the debt is deductible. 10.6 sentence 3 of the Inheritance Tax Act. So only 90% of 250,000, that is 225,000, is deductible. So we have a net amount of 225,000. Now, number 3, remaining property, no inland connection. So evidently not covered by limited tax liability. By the way, ladies and gentlemen, one thing must be clear under all circumstances. In real life, you would never believe that without checking which property is here in play, because people, outsiders, could probably believe that has nothing to do with the inland, and there might be a connection with the inland, or the other way around. So you would check everything. And if somebody says this has no connection with the inland, then you would take a telephone receiver and try to get additional information or write some mails. Now we have a total 225,000. This is to be rounded down again. You remember that there is 10.1 sentence 6. Here again, it's already rounded down. It's already a round figure. Yeah, now interestingly, we have to think about tax clauses, and we have to think about personal allowances when it now comes to computing the tax rate and the tax. So tax clause is tax clause 1, it's a parent-child relationship. 15.1 tax clause 1, that was, I believe, number 2, child. The free allowance in case of unlimited tax liability, it would be how much? Let's look it up. So in case of tax class 1 for children, there would be a free allowance of 400,000, but that applies in the case of unlimited tax liability. Now, in case of limited tax liability 16.2, the allowance is granted but partly reduced. It will be reduced corresponding or down to the percentage which the inland property is in relation to all transferred property which was obtained from the same person within the last 10 years. So what we then have to do here is to look for the complete enrichment worldwide and then to see the percentage which was covered by the limited tax liability. So let's have a look. So in case of unlimited tax liability, our free allowance would have been 400,000, and now in case of limited tax liability, only that percentage of the free allowance is granted which corresponds to the percentage which is taxable under limited tax liability. So here worldwide property transferred this way, not transferred, nobody knows. Orthography, ladies and gentlemen. 200,000 plus 225,000 plus 575,000, that is 1 million. And 225,000 are 22.5% of 1 million. So free allowance here is 25 of 225,000, and that is a figure comes out. Let's have a look. 50,625. 50,625. So taxable amount is 220,000 minus 50,265. Oh. 5625. 147,375. Now the tax rate for this, we have to look to paragraph 19.1 and to look for the right bracket there. By the way, that is to be rounded down to even 100, because that is where the rounding down takes place for the final figure. Okay, now we have to look to 19.1. Okay, here you see it. We have tax class 1, and we have a taxable amount of something in the second bracket. 174,000 and some euros. That is second bracket. That is up to 300,000. That is 11%. So 11% as well. So 11% out of 100. This leads us to 19,173 euro. And now we still have to make the 19.3 test. You remember that was the test. If when we look to the tax at the last threshold, if then there is so much, such a high leap up of the tax that it should be limited to a maximum. So we have to calculate the maximum tax and then compare. So, okay, the tax at the last threshold would have been 7% of 75,000. That would be, no, 5,250. And difference between taxable amount and last threshold would be 174,700, 75,000, that's 99,300. 50% of it is, oh my god, 99,300 divided by 2, 49,650. So maximum tax is 5,250 plus 49,650. 54,900. The tax according to tariff is, how much was it? 90,000. That is lower than the maximum. So 90,100 is the tax which is due. And yeah, there seems to be nothing else. So case is closed. Congratulations if you had that as a solution. If not, look to all the self-evident trivial details which you might have overlooked, because the most trivial detail can bring a point or can improve your solution, or can ruin everything if you overlook something. And then once in a lifetime, it's not a trivial detail. So you get familiar with more and more details of the legal text if you try to leave nothing out. Thanks for watching. Till next time.